Today, FTX gets court approval to sell its crypto assets. The founders of bankrupt crypto hedge fund Three Arrows Capital get banned from doing business in Singapore for nearly a decade, and Anthony Georgiades of the Pastel Network weighs in on recent developments in crypto. Welcome to CNBC's Crypto World. I'm Jordan Smith. Crypto prices moved higher this morning as investors made sense of a ruling in the ongoing FTX bankruptcy that temporarily led to sell-off concerns earlier this week. We'll give you the latest on that in just a second, but as of noon Eastern, Bitcoin rose to around $26,700 and Ether traded around $16.34. XRP traded 2% higher at 49 cents, and it's joining other altcoins like Solana and Polygon's Matic token, which also made gains. All right, let's get you caught up on the top stories. FTX just scored court approval to sell billions in crypto assets. The bankrupt crypto company said the move would allow it to repay customers in US dollars and minimize risks tied to price volatility in crypto markets. In a Monday court filing, FTX said it owns nearly $3.5 billion in crypto, including more than $1 billion in Solana, $560 million in Bitcoin, and nearly $200 million in Ether. And now yesterday, the bankruptcy judge overseeing the case says the firm can now sell up to $100 million in crypto per week. At the same time, the judge allowed FTX to increase the liquidation pace up to $200 million per week, pending sign-off of the two creditor committees. FTX can also now enter into hedging and staking agreements that will let the company reduce the risk of volatility and earn passive income on crypto assets like Bitcoin. The official committee appointed to represent FTX customers in the bankruptcy supported the crypto exchange's request, along with a committee that represents non-US customers with deposits on its international exchange. According to this court filing, FTX hired US crypto firm Galaxy as an investment advisor, partly to manage the risk that information leakage would lead to short-selling activity and sharp declines in the price of crypto. Next, speaking from Singapore today, the co-founder of Ethereum, Joseph Lubin, told CNBC Asia that, quote, "Clear heads will prevail as the SEC continues to dispute with crypto firms in court over whether tokens are considered securities." Lubin, who is now the CEO of blockchain technology company Consensus, also explained why he believes Ether is a commodity and not a security, despite SEC Chair Gary Gensler saying that most cryptocurrencies, other than Bitcoin, are securities. You might remember during a House hearing back in April, Gensler refused to say whether Ether is a security.
I've said Ether is a commodity because the SEC said Ether was a commodity, and the CFTC said the same thing on multiple occasions. And even Gary's indicated that he feels that many tokens are securities, although they really need to be demonstrated to be that. He can't just make that pronouncement. Gary has, in fact, been offered many opportunities to speak publicly about how he feels about Ether, and probably because the SEC in the past declared Ether not a security, I don't think he feels comfortable saying something like that. So I stand by my conviction that Ether is a commodity.
And sticking with Singapore, the country's financial regulator has issued a 9-year ban against the founders of Three Arrows Capital, prohibiting them from operating in the region. The Monetary Authority of Singapore, or MAS, announced today that Su Zhu and Kyle Davies won't be allowed to perform any regulated activity or take part in the management of any capital market service firm. They're also prohibited from becoming a substantial shareholder in those firms. MAS says the prohibition comes after it reprimanded Three Arrows in June of last year for, quote, providing false information, among other things. Three Arrows Capital was once a $10 billion Singapore-based crypto hedge fund that filed for bankruptcy in July of 2022 after a plunge in prices and risky trades left it unable to repay lenders. In a news release, MAS said the regulator, quote, takes a serious view of Mr. Zhu and Mr. Davies' flagrant disregard of MAS regulatory requirements and dereliction of their directors' duties. MAS will take action to weed out senior managers who commit such misconduct. All right, back to FTX's crypto asset sale for our main story. I spoke with Anthony Georgiades of the decentralized platform Pastel Network on the impact for crypto investors. He also weighs in on the shakeup at Binance US and what it means for the industry. All right, so let's talk about FTX off the top. Bankruptcy court just is going to let it liquidate its crypto assets so it can repay customers. We're talking about $3.5 billion in cryptocurrencies here, with bulk of that being Solana, Bitcoin, and Ether. We did see Solana trade lower immediately after that approval for the sale, but it bounced back. So my question is, how much will this sale affect crypto markets in the short term? And is this ultimately something that investors should be watching or concerned about?
Definitely. Well, I think the way that they've actually established the guidelines of the sale have provided a little bit more confidence to the market than we otherwise would have suspected. Obviously, they have $100 million weekly limit in terms of assets that they can sell. To clarify, that doesn't include Bitcoin or Ethereum or stable coins, which have a much higher overall daily turnover and volume. Also doesn't include certain transactions that might happen if you were to bridge a token from a non-native blockchain to the native blockchain, swapping it back to be able to liquidate. So I think the guidelines have been set up and established in such a way to limit the overall market impact. They also brought on Mike Novogratz from Galaxy as an advisor to really assist. And obviously he has a history in both crypto investing, but beyond that, in the public equity markets and futures markets, really on trading execution and overall hedging. So I do think that all of these tactics should shape out to make this as smooth as it really could be, and to fill a bit of that large hole that FTX is still seeing. Now that being said, the overall position in Solana is relatively large. 16-17% of the outstanding market cap is effectively supply that could come into the market. Right now, we're in a period in time, especially with people who are a little bit more risk averse, given both the monetary policy and some of the broader regulatory concerns. So, I do think that we will continue to potentially see price pressure on both Solana as well as some of those more illiquid tokens that are coming onto market.
Some of these tokens, notably Sol, are locked in vesting periods through the contracts with Alameda Research. So there will be some time before we actually see the sale of these assets. But is that ultimately good news for stability of Solana's price, or is that bad news as people sort of wait for that eventual sale?
Mm-hmm. Mm-hmm. A combination of both. Markets, generally speaking, are relatively efficient. Pricing in certain periods. If you have obviously a public equity and you have lockup periods that are expiring, the market is pretty acute in being able to price in some of the potential supply dynamics that might hit the market. Crypto markets and digital asset markets, while they're more efficient than they were several years ago, they're not as efficient as some of the larger market and asset classes around the world. So I don't necessarily believe that those aspects of it are fully priced or baked in to the quote unquote underlying price of Sol itself. That being said, doing it this way is effectively the most prudent way to really offload this particular amount of supply to the market itself. Obviously, for every sale, there needs to be an equivalent buyer on the other side to negate some of the broader price pressure.
The other headline I want to get your take on is what we were covering yesterday, which is Binance US is cutting about a third of its workforce. Their CEO is leaving the company. What's your reaction to the changes over there, especially because they say that this will help set the company up for the next 7 years of financial stability? Do you see that stability for this company, especially given the regulatory environment?
Mm-hmm. Mm-hmm. There's a lot of uncertainty right now with Binance and Binance US, particularly given some of the regulatory crackdown that we saw in the last several months. This current action, while it's been posited as a quote unquote strategic move to preserve cash and resources, and to an extent, I definitely think that it's aligned with the current market environment. The amount of money that they deploy on customer acquisition strategies, sales and marketing, influencers, affiliate marketing, and things like that, which has had a very low ROI at this point in time and is becoming somewhat of a race to zero as it pertains to some of the competitive pressures we're now seeing with traditional finance players moving into the overall exchange business of digital assets and crypto. Having that sort of competitive advantage and moat is somewhat challenging. And deploying resources right now across that strategy is not very fruitful. So I think what they're doing, largely speaking, is both a disciplined approach that speaks to their moves to really stay alive and solvent for the next 6-7 years, however you want to calculate that. But on the flip side, also speaks to probably a large change in strategy and dynamic across the broader crypto industry. It's not as easy as it was to simply hire an influencer or affiliate marketer and go and acquire users for a couple bucks that quickly have a lifetime value of 10 or 100 fold that. Times have changed and it's becoming a little bit more tight and more competitive, and I think it speaks to all of that.
All right, that's all for Crypto World today, but we'll be back tomorrow with an in-depth report on when we can expect Bitcoin's next bull run and what it will take for another prolonged rally. So we'll see you then.